The past few years have impacted the global economy with the pandemic, wars, and political elections around the world. Europe is one of the continents that has been most challenged by the reorganization of the world order. The European economy is still reorganizing after the energy shock caused by the Russian invasion of Ukraine in 2022. But strong threats are emerging on the horizon from both the East and the West, looming over the European manufacturing sector and the international trade of the entire region. On the other hand, the upcoming American elections see Trump as a serious contender for the White House, foreshadowing a change in trade agreements between the two major markets. Trump has always been a strong supporter of strengthening the domestic American market through the use of tariffs against China and even Europe. Welcome back to our channel. This is Vision Economy, and today we will answer this question. Is Europe at the center of global trade war? Let's start with the current context of the European economy to understand the possible impacts of these scenarios and the potential strategies Europe might adopt to survive the double commercial threat. In 2011, the economy of the European Union was on par with that of the United States. But in the following 13 years, the U.S. economy, supported by the expansionary monetary policies of the Fed, managed to grow by 4.4% per year, while the European economy grew by only 1% per year. In fact, during 2023, the economy of the European Union saw growth close to zero, highlighting the difficulties in overcoming the energy shock.
The EU registered a slender growth figure of 0.3% in the first quarter of 2023, avoiding a recession, but inflation is still running painfully high.
Extending the analysis to the entire European continent, we see how the major economies of the continent, Germany and the UK, are going through a period of great difficulty. Germany, the economic engine of European manufacturing, experienced an economic recession in 2023, and the prospects for the coming years likely include a year of stagnation. On the other hand, the UK saw unexpected and record GDP growth in the first quarter of 2024 compared to previous years, thus technically emerging from the recession. In the meantime, flagship European companies like Volkswagen, Nokia, and UBS have collectively announced tens of thousands of layoffs, with the burden of inflation increasing operational costs for industries across Europe. Angry farmers have blocked the streets of Paris with strikes, and tens of thousands of Germans working in the transport sector have recently added protests to the already tense European economic climate. At the outbreak of the COVID-19 pandemic in March 2020, governments around the world flooded the markets with money. The UK and Germany spent over $500 billion, France $235 billion, and Italy $216 billion. However, the United States injected the enormous sum of $5 trillion into the market. The expectation was that inflation in America would rise to unacceptable levels for a long time. But what actually occurred was more persistent inflation in Europe due to the outbreak of the Ukraine war and the sudden energy shortage, which caused energy prices to reach unsustainable levels, damaging economic activity. The good news is that the energy shock has passed its peak pain point, and gas prices have fallen from their 2022 highs, which reached up to $70 per million metric unit.
Take a look at that. Natural gas prices continue to drop. That's the lowest level we've seen in more than 3 years.
Unfortunately for Europe, the prices of other energy resources have just begun to decline. In the meantime, the effects on consumers are evident, especially when considering consumption and savings. European citizens' consumption has grown very little since 2021, with an increase of 4.8% compared to the pre-COVID era. On the other hand, savings have increased significantly by about 200 basis points. Given the rise in interest rates and the economic uncertainties, also caused by the ongoing geopolitical crisis in Ukraine. In addition to a challenging context, the European economy must start addressing pressures from foreign markets. The looming trade threats place it squarely in the midst of a storm of tariffs and restrictions on international free trade, with European legislators currently focusing on China. 10 years ago, Xi Jinping was warmly welcomed in Duisburg, Germany. It was a warm reception for the Chinese president, eager to make Europe a hub for Chinese investments. Over these 10 years, Xi Jinping has kept his promise, with investments from China in the European continent reaching an average of $1.8 billion investments per year since 2014. More recently, another visit by the German president in China received a colder reception. Europe is no longer a continent for China to bring its investments, but it has become a market creaking under the threat of a manufacturing sector that is unparalleled in the world, particularly in Europe and its flagship companies. The first Chinese shock came in 2001 when the country joined the WTO and was able to benefit from lower barriers to entry into the West, beginning to threaten Western manufacturing industries. The backlash experienced by the American economy was significant, while the impact on the European economy was mitigated by a renewed economic alliance and the entry of Eastern European countries into the European Economic Community, which boosted the productivity of the European Economic Area. From that point on, the weight of Chinese exports to Europe has only grown year by year, reaching a market share of nearly 20% in the European major economies in 2023. But this time, the impact will be different because Europe has changed over the last 20 years. With a deflationary scenario ahead, the Chinese government facing great uncertainties at home due to the real estate crisis, triggered by Evergrande's collapse, is seeking new lifeblood for its economic growth from the manufacturing sector. The sector that will be most affected is high-tech manufacturing. Indeed, it is precisely in these sectors that Xi Jinping wants to further grow his China. Just look at the automotive industry, where China is the world's leading producer of electric cars with a market share of 50%, or the production of industrial robots with a 52% share, or even the production of turbines for renewable energy generation, where China produces 60% of the world's turbines. Part of China's strategy is to rely less on Western countries for high-tech supply and increasingly depend on domestic industry, with clear repercussions on Western players in the sector. The automotive sector is a prime example of the application of this strategy. The sector, including its supply chain, employs around 3 million European citizens. The market share of Chinese automotive manufacturers in Europe in the electric vehicle market already represents 9% of the entire market, and just in the period between 2022 and 2023, the number of new registrations of vehicles with Chinese brands doubled. In this growth, all so-called legacy car makers are paying the price. According to UBS, the current market share of 81% of these manufacturers is expected to decrease to 58% by 2030. The strengthening of the Chinese automotive sector could put an end to the dominance in Europe of historical players like Volkswagen and Stellantis. While on one hand, European industries are threatened by the growth of the Chinese technological sector, on the other hand, Europe is now dependent on Chinese exports. According to a paper by Julian Hinz, if Europe were to loosen its dependence on China, it would pay a high price with increased prices and direct consequences on already strained consumption, sacrificing approximately 1.2% of GDP. Considering the inflationary risk arising from the imposition of prohibitive tariffs aimed at confining Chinese exports, a plausible scenario is that Europe may exploit the strengthening of the Chinese manufacturing sector, and so the arrival of cheaper goods in the European market, in order to mitigate the inflationary pressures that characterized recent years. This would also provide the opportunity for the European Central Bank to implement expansionary monetary policies, lowering interest rates in an attempt to stimulate economic growth in Europe. But if on one hand, Europe must look to China and protect its manufacturing sector and its excellence, on the other hand, it must also look to the other side of the world, the United States. Within the year, the American elections will take place. And if the winner coming out of the polls were to be Donald Trump, the shadow of further tariffs would once again loom over Europe. This time from the American direction, which could further endanger European industries. Trump was sentenced in May 2024 in the Stormy Daniels case. But the verdict doesn't seem to have dented public opinion.
Do you know about the $130,000 payment to Stormy Daniels?
No.
The case has been known since 2018, and Donald Trump has framed the trial during his electoral campaign, portraying it as orchestrated by the Democrats to undermine him before the November elections. The outcome of the matter is far from certain, but Trump remains a candidate for the presidential seat. The last time Trump was president of the United States, he imposed tariffs on steel and aluminum imports, including European exports. As of today, Trump, favored in the polls over his contender Biden, threatens a fixed tariff to be imposed on Europe of 10% on all imports. Among the multitude of motivations, three main reasons stand out for the plans of Trump supporters. The first concerns America's frustration that the EU has been reluctant to take a more aggressive approach regarding China, both in terms of its own duties on Beijing and restrictions on strategic investments by Chinese companies. Europe, therefore, faces pressure to employ restrictive measures towards the Chinese industry in order to appease potential retaliatory actions by the United States. The possibility of a response from the European Commission is real.
But global markets are now flooded with cheaper Chinese electric cars. And their price is kept artificially low by huge state subsidies.
Ursula von der Leyen, President of the European Commission, has warned China not to compete at the bottom of the green tech industry, describing Chinese competition as unfair due to the use of state subsidies to rival European manufacturing companies. It is also worth noting that the frontrunner for the Republican presidential nomination has proposed slapping a 10% tariff on all imports and hiking those on Chinese imports by 40 percentage points to 60%, were he to defeat President Joe Biden on November 5th. The second major motivation driving candidate Trump to promote the propaganda of a 10% baseline tariff isn't entirely conceived of as a response measure, but also a policy to bolster the long-term global manufacturing position of the U.S. According to a Trump campaign official, it would spur billions of dollars of revenue that would give Washington space to cut taxes on domestic producers and others. Indeed, it's no secret that the Chinese manufacturing sector has gained a significant advantage over the United States in recent decades, representing over 30% of global manufacturing production, while eroding production in the United States, which stands at 12%. This tariff shock would temporarily shave 1 to 1.4% off U.S. economic output in the early years, mainly due to higher consumer prices and unemployment weighing on consumption, and a confidence shock that would affect investment in the short term, according to the IW study. But improvements in the trade and fiscal balance would allow U.S. gross domestic product to recover to be only slightly negative by 2028. The potential measures against Europe would also serve as a major component of a broader initiative to complete a third objective, namely, overhauling U.S. trade in goods. The nation has had long-standing large deficits with the EU, with 2023 data on track to mark a third straight year of an imbalance, exceeding $200 billion. It goes without saying that the tightening of tariffs would cause a considerable impact. Last year, Europe sold $500 million worth of goods to America. In fact, 20 of the 27 European member states have a trade surplus with the U.S. They export more to the country than they import. The fate of the European market hinges on these balances, which it must manage in the coming years. Saving the manufacturing sector in Germany, the economic locomotive, is the top priority on the agenda of European legislators. Germany is indeed the protagonist of the next video we recommend. Its role in the European economy is unparalleled on the continent. Click here to learn more.